Should we buy or sell Retractable Technologies? First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. And you can also get, the premium access here. Get all of this stuff. Okay, so let's jump into the website here for the company. Retractable Technologies. We make safety safe. RTI designs and manufacture safety medical devices featuring automated retraction technology, proven to effectively reduce the risk of needle stick injuries. So this is definitively something that is very, very valuable. There's a lot of injuries in this industry, and hence they are solving a very real problem. So this stock is part of a megatrend that I call physical security / safety. 15-ish% from the 52-week low, minus 39% pullback. So we have definitively seen some selling. Here is the stock. Safer syringes, 8% here from the 52-week low, minus 75% pullback. So let's jump into the charts. So this is a big picture weekly data points, and what I do find interesting here is that we have these time cycles: rise, decline, rise, decline, rise, decline. So the current sell-off is so ferocious that it is pushing into what supposedly was going to be a rising phase here. But at least we do have a time cycle that is in its bullish phase. So we are sort of due that time cycle rise. But as we saw, there's been problems. So let's actually draw in here a very interesting moving average that is in play at this point. That is this one, this red 200-week moving average. It was, support back here as well, even back here and here. So it is a moving average with a lot of legitimacy. As such, the thesis would be that it will attract bulls now. Whether it works or not as support is completely dependent on a sufficient number of bulls using it as support. But at least this one is something to have on our radar. So that is on the weekly data points, a clear support level, and price action is surgically reacting to that moving average. So obviously it matters. Looking at the daily data points, it is pretty clear that the bears are pretty aggressive. We are in a very substantial downtrend, below all kinds of moving averages. However, we did see here on Friday that we were able to break out above this 5-day moving average. Let's draw that in so you can see here that for quite some time, a 5-day moving average, resistance, 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 resistance. But then all of a sudden on Friday, we were actually able to break out of it. That is a very initial, early sign of the bulls at least doing something. And given that it comes in the context of us being at that moving average support level, it becomes especially interesting. It's a very early sign, but it is a sign of a change. Another pattern that is here quite clearly is this. Let's draw it in. We do have something that looks a lot like a potential double bottom in development. That is another technical pattern that is bullish and interesting. Okay. If we look here at these other indicators as well, we are at an extremely low RSI level historically. Many times these lows have triggered mean reversions to the upside, along also with the distance from these moving averages reflected through the PPOs. But there have been times where there's been even more sell-off. Here on the daily data points, we do see that we are at that extremely low level. We are very oversold. So from a more contrarian perspective, that is bullish. Looking at the seasonality over the last 5 years, January and February are some of the strongest months. Over the last 10 years, then January, February are strong. But April and May are weak. And then over the last 20 years, then January is one of the, well, it is the strongest month. February is mediocre. March is, relatively speaking, strong. We certainly have not seen any strength in January so far. It begs the question whether the typical strength we tend to see in January has now been delayed, as such that it will be reflected in the share price later. At least that is a hypothetical outcome. Here is Finviz, and we do see that there's been a lot of selling over the last year, minus 67%. The reason why this stock is extremely interesting, if we do get some low, so let's actually measure it. If we look at the previous time we tested the red 200-week moving average back here, from that low to this high, that was a 1,700% gain. That is a huge, huge, huge rally. So it is when things look really ugly that you can get those kinds of moves. Obviously, it is very hypothetical whether that will happen again, which is why we look at corroborating data. Okay, do we have additional reasons beyond the technicals to be a bit bullish or not? So market cap is 173 million US dollars. So it's a small company. So minor good news for a stock like this will have a very dramatic effect on the share price. That's one of the benefits of being a small company. Well, at least certainly from a shareholder perspective. Looking at the insiders, we do see that there was some selling here, but in 2020 we did have a lot of buying. But it's quite some time since the insiders made a move. The latest move here is from April last year. So basically, the insiders have been holding on. So at least that is it's good. But ideally, we would want to actually see them buy, but they haven't been selling either. So yeah. On Market Screener, we unfortunately do not get any price targets. So this is a company that it's so small that it doesn't attract analysts. Here, Sachs doesn't have any real fundamental analysis of the stock either. Yeah, we are operating on very limited information. Though we have data in the charts and the seasonality, nonetheless. And when we look here at the problem they are solving, it definitively is a very interesting problem. And we have seen before that the market has reacted extremely positively to that solution. And the sell-off here, it does come in the context of a major sell-off in these high-flying growth stocks. The sell-off has, however, been so spectacular across the growth stocks that it makes more sense to look for bullish opportunities than to speculate on statistically low probability further declines. It is possible, of course, that we are going to see like record low. So here we have the correlations. So we do have a 74% positive with the S&P 500, 76% with the healthcare XLV ETF, and 81% with the IHI, which is the healthcare devices ETF, and minus 83 with the dollar index. Daily data points: minus 57% the SPY, minus 25% XLV, 24% positive with IHI, and then minus let's say 89% with the dollar index. So we did have a very strong correlation. Well, comparatively speaking, we had a strongest correlation with the IHI, which is the healthcare devices ETF. IHI. So that is the one whose price action will most likely have an effect on retractable technologies. So what is interesting here in the chart is that we do see, so let's actually draw that in. There clearly is a head and shoulders pattern in development, and we could form that right shoulder. And in order to form a right shoulder, you initially will have a rally. So it will then go up like this. That is momentarily, if it happens, of course, and there's always an if, that would be bullish. So that is a development that would be beneficial to medical devices stocks. When we look here at the daily data points for the IHI, extremely oversold, I guess. Yeah, extremely oversold. It reached the levels last seen here during the lockdown. As a matter of fact, it actually got even more oversold. And you can see that historically speaking, it does have a tendency here on the daily data points to explore the upper and the lower regions here of RSI. And also the PPOs, they have this dynamic wave effect. They go, you see that, quite clearly, they go up, they go down, up and down, up and down, up and down. So that is how this security behaves. At least it has behaved so far, and that's why we can sort of safely-ish assume that that is the most likely development going forward. Given it recently was extremely oversold, most likely we will see a temporary, at least, a rally. But it could be that rally is just a part of forming a major head and shoulders pattern, which is bearish. But I think that, when we look here at the technicals, for retractable technologies, there's more reasons to be bullish than bearish. What we saw on the technicals definitively is not supportive of going short. When we look here at the seasonality, it's a bit messy, but we didn't get that super strength in January, so maybe it's been pushed out into February, which would be bullish. The fundamentals is the problem is that we do not have much data there. So that is one of those obscure factors. Looking at the ETF, it was most strongly correlated with, beyond the dollar, which is not an ETF, of course. It is interesting to see that even in that one, that corroborated a bullish thesis. So yes, there's more reasons to be bullish than bearish, but as always, we want to have a stop in place, and that red 200-week moving average is a very clear line in the sand.